There are several advantages of debt financing. Retain ownership and control. When a business opts for debt financing, the borrowed funds do not dilute the ownership stake of the existing shareholders. The business retains full ownership and control over its operations, as lenders do not become equity shareholders with decision-making power. Tax benefits. In many jurisdictions, the interest paid on debt is tax-deductible. This means that the interest expenses can be deducted from the business's taxable income, effectively reducing the amount of taxes owed. This can result in significant cost savings for the business. Predictable repayment structure. Debt financing involves regular fixed payments, principal and interest, over a specified period. This predictability can help with financial planning and budgeting, as businesses know exactly how much they need to repay each month or year. Leverage for growth. Borrowing funds through debt allows businesses to leverage their existing resources and assets to raise capital for expansion, research and development, purchasing equipment, or other growth opportunities. This can help accelerate growth without requiring immediate equity investment. Time-limited obligation. Debt financing involves a fixed repayment period, after which the debt is fully repaid. Once the debt is paid off, the business is no longer obligated to make regular payments to lenders, and the business's obligation to lenders ends. Faster access to funds. Compared to seeking equity investment, securing debt financing can often be a quicker process. If a business needs funds urgently, obtaining a loan or credit line can provide quicker access to capital compared to the process of finding and negotiating with potential equity investors. Flexible use of funds. Debt financing does not generally come with requirements or restrictions on how the borrowed funds are used. This allows businesses the flexibility to allocate the funds according to their specific needs and priorities. Build credit history. Responsible debt repayment can help a business build a positive credit history. This makes it easier to secure financing in the future at more favorable terms. No dilution of ownership. Unlike equity financing, where new shares are issued and ownership is diluted, debt financing does not dilute ownership stakes in the company. Existing shareholders maintain their ownership percentages. However, it's important to note that while debt financing offers these advantages, it also comes with potential downsides. Businesses should carefully consider their financial position, cash flow, and ability to service debt before pursuing this financing option. FAQ section. What is debt financing? Debt financing involves raising funds for a business or project by borrowing money from external sources, such as banks, financial institutions, or investors. The borrowed funds are repaid over time, typically with interest. How does debt financing impact ownership? Unlike equity financing, debt financing does not dilute ownership. Borrowers retain their ownership stakes, and lenders do not gain decision-making power in the business. Are there tax advantages to debt financing? Yes, interest payments on debt are often tax-deductible. This reduces the taxable income of the business, leading to potential tax savings. Can debt financing help with business growth? Yes, debt financing can provide the capital needed for expansion, purchasing assets, research and development, and other growth initiatives. It allows businesses to leverage their existing assets for growth without immediately giving up ownership. Is debt financing suitable for short-term or long-term needs? Debt financing can be tailored to both short-term and long-term needs. Short-term needs might be addressed with working capital loans, while long-term needs like expansion can be financed with longer-term loans or bonds. Does debt financing have a repayment schedule? Yes, debt financing involves a fixed repayment schedule. Borrowers make regular payments of principal and interest over a specified period until the debt is fully repaid. Can debt financing help businesses build credit history? Yes, responsible repayment of debt can help businesses establish and improve their credit history. This can make it easier to secure financing in the future. Are there risks associated with debt financing? Yes. There are risks such as the obligation to make regular payments even during financial challenges and the risk of default if the business can't meet its debt obligations. Businesses need to carefully assess their ability to service debt.